Welcome back to Return My Capital. Today we're going to take a look at a very popular ETF called VTI. You should be receiving a dividend payment from VTI on Monday, the 31st of March here, which is always great. So we'll take a look at this, how it relates to some other very common ETFs, and specifically take a look at the dividend payout that you should be expecting. It was recently announced. So just as a quick general recap, VTI, Vanguard ETF, Vanguard product, it is tracking the US total market index. So not just the top 500 companies in the US, let's say, investment world like VU is tracking, but this VTI product actually tracks over 3,600 companies across large, obviously your mega cap tech giants, mid, small, and micro cap stocks. So whereas VU is tracking the S&P 500 index, that's why it's roughly 500 or so companies in VU, VTI is actually tracking the US total market index. So what that results in is about 18% or so of the VTI ETF contains companies that are not included into VU. Typically, by recent metrics, a company had to have a market cap of at least 200 billion, at least as early as 2025 here. And you have to have consistent profitability over the past 4 quarters, high liquidity, a couple other factors such as public float to be included into the S&P 500. Now with VTI, you don't have those restrictions, right? So you can include much smaller companies and those that may not meet the profitability requirements to be included into that S&P 500 index that VU is tracking. So again, because the S&P 500 contains the 500 largest or so US-based companies, those companies are still going to make up 82% of the total index that VTI is tracking. But of that remaining 18%, you've got still large cap companies, but mid, small, and micro cap stocks. So again, VTI 3,600 or so stocks, whereas VU roughly 500, a few more actually. But so there are 3,100 additional companies that are being tracked by the VTI index ETF. Some of those companies, some of the largest companies that are in VTI and not in VU would include the likes of Marvel. And, this was just from a little bit of research I had done. So please let me know if I'm wrong on any of these, if any of these companies are actually included in the S&P 500 now, but I think this is right. So you've got Marvel Technologies, big semiconductor company, market cap of 70 billion. So because of certain factors, it's not included in the S&P 500, but it is still certainly a large enough market cap company to be included in the S&P 500. You've also got Workday, Snowflake, which I thought Snowflake was added to the S&P 500, so let me know if I'm wrong on that. You've got Block, formerly known as Square, the artist formerly known as Square, Datadog, Viva Systems, Coinbase, Twilio, Roku, Unity Software, DocuSign, Hims and Hers. That one's really been blowing up lately. I thought I might have seen an announcement for Hims and Hers, ticker symbol Hims, recently about being added, but I might be wrong on that. Toast, a very, very popular point of sale system company now. But that's just an example of still, these companies can be massive companies and yet not be included in the S&P 500. So they'll be included in VTI, whereas they wouldn't be included into VU. So let's take a look here at the investment product page directly on the Vanguard site for VTI here. You'll see what everyone loves most about VTI is exposure to a very broad index of 3,600 US companies, but only carrying a 0.03% expense ratio. So essentially zero cost to own, which is great. You'll see the performance here over the past 14 years or so. Let's take a look at the total return by NAV column here. And what you're seeing here, this is why passive investing works. You don't have to take risk on individual holdings. Not to say that there's anything wrong with that, but you can't be upset about the returns. Granted, previous returns are no indicator of future returns. I get that. But I mean, you're seeing previous years here, starting with 2024, you're seeing a return of nearly 24%. Prior to that, 26%, a down 20%. Prior to that, returns of 25, 20, 30%. So you see how over the course of time, even a small investment into a broadly diversified index fund, or ETF rather, like VTI, can just compound over time. One other thing that is interesting that I'll call out, you see the returns. Typically people like to say your average return is your 8 to 10% or your 9 to 11% in VTI or VU. But what you'll notice is that while that may be the average return, the mean return, typically years don't fall within that say average range. You're seeing years of up 20%, down 20%, 0, up 30%, down 5%. So it's not oftentimes that you're actually seeing an annual return of, we went up 8, 9% this year. It's usually significant up, significant down, 0, whatever the case is. But over the long term, it averages out to that, say, 10% return that you can hopefully expect going forward. But we'll see how things shake out. Here, you're just seeing a historical price chart over the 10-year. So roughly a 300% return. We're looking back in March of 2015 at 107. Now currently trading February 28th, 2025. We're quoted at $292 per share. Obviously, that's not super up to date. That's a month old. But again, 300% return over 10 years. No one's going to be upset with that. Here you'll see the 3,608 stocks contained within VTI. It lists a median market cap of 204 billion. I don't think that's actually accurate. I think that's probably the mean market cap, because you do have those mega cap tech companies that would skew an average, whereas the median is going to just be the middle market cap. So say the market cap of the 251st company, or whatever the case is. But that being said, pretty elevated price to earnings ratio, 26.1. Again, I don't know if that's entirely accurate. That sounds a little high, but I do know that we are certainly trading at elevated levels, as some of those high multiple stocks, typically tech stocks, are dragging up the average price to earnings ratio. Here we're seeing the weighted averages of the various sectors. Materials, smallest of all 11 sectors. So materials are only 1.5% of VTI. Consumer discretionary has been charging up at now 14.7%. I believe consumer discretionary is primarily Amazon and Tesla, but don't hold me to that. Consumer staples, 4.2%. That's pretty low for the staples. Energy, 3.5%. Financials up to 12% now. Financials have done pretty well over the last 6 months, year, I believe. Healthcare is down to 10.6%. I believe the healthcare sector in general has been beaten up a bit lately. We've got industrials at 12.7%. Real estate, your REIT, at 2.7%. Technology all the way up at 33.4% now. That's quite a weighting in the overall index, especially when you consider that it contains 3,600 companies. Telecommunications, surprised to see that is only at 2%, because I believe telecommunications holds Alphabet, also known as Google, or maybe that's Facebook, Meta, but telecommunications at 2%, utilities at 2.7%. Here you'll see the top holdings on a 1 through 10. Again, Alphabet is broken out into Class A and Class C shares, but you can really obviously count that as one company. So let's say this is the top 9. Certainly, if you've been investing for any amount of time, you're familiar with all of these, as they are essentially all of the mega cap tech stocks. We'll take a look at 11 through 20 here. You'll see Eli Lilly. That's an often forgotten name, a very, very large healthcare company. JP Morgan Chase, the largest financial. Let's see, ExxonMobil. Is ExxonMobil larger than Chevron? Yes, it is. So ExxonMobil, the largest energy company. You've got your payment processors and Visa and MasterCard. Costco's in there. You see you don't fall below 1% weighting of the entire index until you get to ExxonMobil. So say the top 13 holdings all carry a 1% or higher weighting in the fund. Let's see, looking down, you've got United Health, Walmart, Netflix, Procter & Gamble. So I guess that would make Procter & Gamble the largest consumer staple. 21 through 30 here, a mix of J&J, Healthcare, Home Depot, AbbVie is excuse me, brain farting here, a healthcare pharmaceutical company. Bank of America, so there's your second bank. I was surprised to see Wells Fargo made the top 30, coming in at 28 here. Also surprised to see Philip Morris slotting in at 30 here. I know that the sin stocks, the tobacco stocks, have been performing extremely well lately, but surprised to see it as the 30th largest, or I guess 29th largest company in the U.S., if 29th if you count Alphabet as one company. Oh, there's Chevron. Okay, so there's your second energy company. So I won't go through all the holdings, but just wanted to call out the top 30 there. Here you're seeing a little bit of dividend history. So again, dividends coming on Monday, March 31st, and it was recorded on the 27th. The upcoming dividend is going to be 98.5 cents per share. If you compare that to the year over year on a quarterly basis, let's go ahead and look back at March of 24. That compares to 91 cents per share. So 91 cents up to 98 cents now for the March payout for VTI here. And let's actually break this out on a better view. So looking at the historical yield here for VTI, you see that the yield is near the bottom of the chart here. I guess it bottomed out at 1.2% yield in February of this year. Compare that to back in October of 2022 when the yield was 1.7%. So again, we're not talking about a high yield investment, certainly, but simply the reason for this is not, dividend cuts, dividend eliminations. It's purely the reflection of what the stock price has done for this ETF and for the US market overall. So when this ETF was yielding 1.7% back in October of 22, the price for a share of VTI was $180, almost $181. Now, if we look at the all-time low of a yield of 1.2% in February this year, price was $302, almost $303. So that's why you're seeing the dividend yield reflect in that nature. If we look at a bar chart of the historical dividends, a little choppy on a quarter by quarter basis. Not all companies pay out the same dividend, each quarter, right? So that's why you're going to see a little bit of chop here, but generally a trend up and to the right. So if we go back and look at the March payout in 2020, 61 cents. In 2021, 67 cents. 22, you have 71 cents. Over to 79 cents in 2023. All the way up to 91 cents in 2024. And again, for March 2025 here, we're expecting, or it's been announced, 98.5 cents. So this is where you see the compounding effect take place. Here, you'll see quarterly distributions going back several years. Again, on a one quarter to the next, it's not always going to be consistently growing because the payout for Q2 may be lower than the payout in Q1. However, that's structured, not an issue. The important thing is that you're seeing quarter over quarter increases, right? So again, for Q1, which is what we will be receiving on Monday for 2025, we are seeing that steady upward slope in the curve. So again, let's just go back through the Q1 dividends for 2025 here. Coming on Monday, it's going to be 98.5 cents. Compare that to a year ago, 91 cents, 79 cents, 71 cents, 67 cents, and 61 cents. So certainly that's trending exactly how we want to see. Looking very, very quickly here in Seeking Alpha, over the past year, VTI is up almost 9%, down slightly on the year to date, let's say 3.5%. But then you go and look over the past 5 years and 10 years, up almost 161% over the past 10 years, just phenomenal. You see again here this 0.03% expense ratio. Scrolling down, you'll see the price returns. Let's go ahead and compare to the S&P 500, which is typically in most holdings, most portfolios, I should say, rather, people tend to own either VTI or VU. It doesn't make a whole lot of sense to own them both. But let's see, total returns compared to the S&P 500. We are looking at 211, let's say 212% over the past 10 years for VTI. That compares to 232% for the S&P 500. So about 20% less return for VTI as it compares to VU over the last 10 years, as those mega cap tech stocks have simply outperformed and dragged the S&P 500 performance up. Pretty much the same picture over the 5-year chart. So VTI over the last 5 years, 130% compared to 135% over the last 5 years for the S&P 500. You see that sector breakdown again here. Again, primarily technology, followed by financials, healthcare, and consumer cyclical. Already covered the top 10 holdings. The 5-year CAGR of VTI, so I guess you could really say the 5-year dividend CAGR of US market is 6.5%, let's say. Nice bar chart here showing the dividend growth history, steady up and to the right over the last 10 years. If we go back and look at the annual dividend for 2014, that was $1.87 for VTI. Now let's kick it out to what was received last year in 2024, $3.67. So over the course of 10 years, you went from $1.87 to $3.67. So again, that's where you see the compounding snowball effect take place if you are a buy and hold investor and just reinvest dividends with a broad ETF like this. Very quickly, just to call out a couple of peers. So certainly we've mentioned VU, which is another ETF from Vanguard, just covering the S&P 500 index. You've also got DIA, which is the Spider ETF tracking the Dow Jones index. So I'll do a video dedicated to that and the Dow Jones index, but slightly higher expense ratio, but still a fairly minimal 0.16%. Let's see, IVV is an ETF from iShares, again covering the S&P 500 index, similar to VU. And then you've got IWM, which would be the iShares Russell 2000 ETF. So really the IWM would be a little bit more comparable to something like VTI, since it's covering 2,000 stocks, whereas VU is only covering 500. So this is just a little general recap for VTI. And again, if you hold this ETF, should start to get excited. You've got 98.5 cents coming your way next Monday, the 31st of March, dividend distribution Q1 2025. Thank you very much for watching Return My Capital. If you learned something today, please give me a like, give me a subscribe if you want to see more content similar to this. And again, let me know if I messed anything up on those companies not included on the S&P 500. Thank you very much for watching. Take care. Bye-bye.